S&P closes at an all-time high. Why this one subsector of the capital markets is exploding. The VIX breaks $12 and why it's not broken. Federal funds rate is at a 20-year high and why you should care. JP Morgan at all-time highs and why it's going higher. What sectors are leading in 2024? The answer might surprise you. New York Stock Exchange margin debt is growing, and how this is affecting trading. The chances of a rate cut are increasing in September and how this is affecting the dollar, the 10-year bond market, and equity prices. Smart money, dumb money, and the trigger that just happened this week. We have a ton to go over. Let's get to it. Before we begin, I just want to thank everybody for continuing to comment on these videos to make them better and also for sharing. It means a lot that we're able to get the message out there to show people what it truly means to be successful at trading and ways to do it. Let's get to it. Hey everybody, welcome back. Well, the S&P 500 went and did another thing and made another new high. Comparison to everybody's thoughts about the end of the world and the crash. That's not exactly what happened. We're going to go through the basics to start with. There's an inordinate amount to cover in a very short period of time. But one of the things that I just want to point out is just take a look at this. Let's start here for a moment because I think this is pretty interesting. All we did on the RSI was just really work off the overbought. I have four major charts we're going to go over on the indexes, and then I want to go through the dollar, what's going on with the 10-year. But we really got to look at smart money, dumb money, and the transfer that happened there. And people really have to understand why this volatility in tech is here to stay. But let's just jump right into it. So it's not realistic that you're going to stay at an 80. And let me just blow this up for everybody. It's not realistic. And you worked it off, and you couldn't even break the 50 on the weekly. Now, that's where you're oversold or overbought. But what is important for people to get about that is you usually stay overbought or oversold for a period of time. That's why when you break that level, you have to understand that it's significant. So if you take a look at the break under that level right here, you'll see that that is the biggest underperformance from where you had in the market, right? So again, it's not just, oh, this is something that is an issue. The issue becomes the fact that you're just going to underperform. And that's really all you've done there. You fell down and you kind of went sideways for a bit of time, right? And when you did it here as well, what happened? You underperformed. And that's the beauty of what we're trying to do here is I want you to understand that just when you point something out, what does it actually mean? And this is pretty clear. Then you can see the flip. Now it's when you're over that you're going to get outperformance. And you should be able to see that as well. Anything over outperformance is. So what you want is when this breaks, because it determines the magnitude of the move, you just don't want to go below 50. And that's really how you need to look at it. Anything below 50 and you're like, oh, we're going to underperform. Anything over 50, you're like, okay, we're good. We have a chance of going higher, right? But if you're under it on a weekly, it's not very likely. If you take a look at this with the NQ, just as well to just get into it, we came right to 50 and held. That's not a coincidence that that's where we stopped at. Now, the day before, you don't know that, right? So you want to constantly monitor it. These are charts that I look at not only on a daily basis, but on a weekly basis. I just want to see what's going on. Doesn't mean I'm going to act on it, but if I'm coming down like that, I got to go, okay, am I going to undercut and bounce? It becomes a place of interest, right? Whereas here, you're not really too worried about what it's doing. It's just grinding higher, but this becomes a place of interest for me. And you can see how we held here perfectly. So this gives us pretty much the rundown. One other thing that came to mind when I was getting this video ready was also just to show people how to use the heat map, the correct way to use the heat map. And I will get into that. It's a really quick tip and it's something that you can understand. I'm also watching people when they send me emails that, how to get out of their option trades. And the majority of people seem to be doing it wrong. So I'm going to give you an example of a GME trade that we did on puts, and I'll walk you through that as well. But what you're looking for here is that 50. As long as we're above 50, we're good, right? Okay. Again, this video is going to be packed, but let's follow with the ES because the S&P 500, because these are charts, again, that I'll look at not only weekly, but daily, just what's going on. So this is the S&P 500, and in here, what do we have on the weekly? All right, so we have the bands, Bollinger Bands, but what I've done with the Bollinger Bands is I've done something a little bit different, and if you're new to this video or watching these videos, welcome. I make my own indicators sometimes, or I tweak them to work the way that I think the indicator should work. It's really important for me that you understand what indicators are and the measurements of them, because that's how you utilize them, right? If you don't know what they are, you're just regurgitating someone else's information. So now if you take a look here, what did we do? All right, so the bands. So the majority of bands, what people will do is they'll say it's the second standard deviation, right? That's true Bollinger Bands. They go out to the second standard deviation, and then if something happens, then you're supposed to do something. I like looking for extremes with the bands. So for me, I put in the first, the second, and the third. And all we did was here on the weekly was just get right back to the band, hold the band, and then bounce. Very little to say here, very little to do. And I think that that's significant. So we didn't really do anything. We're not really overbought. We're just kind of hanging out in there, and we're really at that first standard deviation. Now, again, the significance of this is to stay in the range, right? Just stay in that first standard deviation range for us to trade in there. well, 67%, pardon me, 67% is that first standard deviation, right? So basically everything should be in there. Second is 95%. And then third is 99.7 of all trading should be in there. So I'm always looking for, okay, something extreme. If I pop out down on a third standard deviation or up on a third standard deviation on a weekly or even a daily, I want to know, for example, if I go here and I just show you this because people say, well, how do you use this? And, I'm glad you asked. But see how you're writing a third standard deviation down here? At some point, you have to go, okay, well, you're setting up here. And obviously, this was a pretty easy trade. But even when you're popping out over here or something, you just kind of have to go, okay, well, this is getting a little goofy. We're riding the third band down. Yeah, that's probably not going to last, right? Like at some point, this is going to end and you're just waiting for it to end. And there's other triggers, and I can do a whole video just on how to use the bands, right? And I use them as more of a guide than anything. But it's really significant because you can even see it here, how you're popping out the reversal off the third standard deviation back there during the pandemic. Let's just keep rocking and rolling here. And we should probably just take a look at the NQ here for a second so you can see that as well before we dive into the dollar and what's happening there and the 10-year, because there is significance there that we have to go over. But we undercut here. And the volatility of the NASDAQ obviously can't really be, overstated or understated. I mean, it's obviously going to be more volatile, but I think people misunderstand volatility. I really think that they're missing something here. There's a lot of money to be made off volatility, and I'm going to explain it later in this video, what you could be doing about it. But all right, so you're at that third standard deviation right here. It gets wider. Great. So it gives you an understanding of what's happening there. You start looking at how you're riding up here. You're not really doing anything of consequence except what? Flip the first and pushing. So this is where you need to pay attention to this kind of stuff. Why? Because what people will say, like you can see it back here as well, you're pushing that third. People say, oh, well, we're back to highs, so that's going to be a problem. Well, according to statistics, it's really not an issue. You're not really too stretched up here, are you, on the NASDAQ? Even though you're closing at new highs. People are like, oh, it's too high. Is it? Why? Because you say so? I mean, this is basically telling you that you're not even out of the realm of what would be statistically normal. And I think that that's important for us to understand. Let's keep rocking and rolling. And then if we just look at the basics, and I use a 12, a 22, and a 55, and these are weekly charts, I think it's important to take a step back and look at things from a 34,000 foot view on the weekends. I tend to do that. Sometimes I'll even look at the monthlies. But I like to do that at the end of the month, frankly. But look at this. Like if this was a chart, it would be in a textbook, and it's just perfect. You mean we tried to break out, we failed, and then we broke out? Yeah. And then we ran up, and then we pulled back to the 22, and then we went higher? Yeah. I mean, this is like grade school kind of stuff when you look at it. Meanwhile, we're in here, reading the tea leaves. What did this Fed guy say? What did that Fed guy say? What's the CPI? Don't get me wrong. I do it as well. Obviously, if you watch these videos, I love the data and I love the game. I've been doing it 25 years. I wouldn't be doing it if I didn't love it. And pardon that you can hear the slurping. Someone told me to get a much better mic, and I did. But if you hear that, you can thank him. But if you see how the break is heading up right here, I mean, is there anything really to do except just watch this? I do think based upon the volatility that you're going to start seeing broad-based buying in some of these sectors that you're not used to. And I'm going to get into one specific sector and one specific subsector that has a new revenue stream that's non-tech, that people are they're completely misunderstanding what's going on there. If you're in the community, you already know. But here's the ES, just very simple to take a look at, isn't it? Very clean, very simple chart, right? If we come back over here again, and we just put the NQ in just for a moment before we jump into the dollar, what do we see? We see a test, right? And then we see it up. Like this is why I love technical analysis, because it makes you feel so stupid after the fact. Like, oh, well, clearly all we were going to do is just backfill. Yeah, you don't know that. This is why you want to be constant. And this is what I tell people. You want to constantly be looking at these charts. You don't want to just look at them once in a while. You want to set up a pattern if you want to do this to be successful at it, where these are the 10 or 20 charts I look at a day, whatever they are, it doesn't matter. And then you'll add and you'll subtract. Oh, I found no value in that. That was a waste of time. Or, hey, this was really significant. I should build on that and utilize that through the indexes and sectors, because that was a lot of fun. So when we take a look at this, right, pretty nice. Okay, let's rock. So here's the ES, and then here's the NQ. Now on the NQ, by the way, I'm on the trading view. and the amount of data that I'm going to be able to condense by learning some of the functionality of this and get out faster is just absolutely amazing. Not a plug, just telling you what I'm doing. You can see the tabs up here. I'm actually able to just literally just click through these tabs, and it just makes my life so much easier, so much faster. So if you have the ability to get the app and you use it, do it. But anyway, so here you are flat, comes down to the retest, fills the gap. Here's the hammer. We talked about that 3 weeks ago, and now we're pushing. What's all this being driven by? This is all being driven by the dollar and the 10-year. Let's clean off my levels for a moment and just talk about what's going on up here. Now, if you look at TNX, you got right to that level. And what's so significant about that is this is right around what? This is right around when the Fed spoke. And since then, you just really have never been able to lift. I mean, obviously that's the bar, but if you come down to that level where we closed, you just really can't get over it. And I think that's significant. You know, that's right where Powell said we're not going to raise rates anymore. And I do think there's significance to that. And I do think it's worth paying attention to. If you look at the dollar, what's the dollar really doing here? I mean, what's it really doing? You got right to this level, you know, right in November, and then you come back to this break and go, okay, well, this is when the dollar really broke down. Why did we break down, you know, from October 31st here? Well, they said they weren't going to raise rates anymore. So where have we gone since November in the dollar and the 10-year? Nowhere. The difference is if you take a look at these same levels, and this was what was a concern of mine earlier, where have we gone from the dollar and the 10-year really haven't moved, but what's the equity markets done since that time, right? And so this was always my concern that, well, we're up like 20%, but it's really becoming earnings driven, and the amount of companies that are coming out and beating earnings are pretty significant. And you can even see that as you go through the sectors. So if we look at the sectors, and we just go back for 24, because I think it's good to kind of take again, you want to take these snapshots on the weekly, daily. I look at this stuff even on a minute by minute basis, depending upon what type of trading I'm doing. But if you go 24 and go, well, what's the big winner? Well, it's Bitcoin, it's semiconductors, it's the pot names, and it's China. So there's some misconceptions, and I want to go over them specifically with option trades, specifically when you guys are trading GME, AMC kind of option. This is where this account is at year to date. And it started, for those who have been following along, this started with, I think, $1.60 or $1.70. The important thing that I want to show about this is more not just this, but really just focus on not so much even trade expectancy, but this is TradeZilla. I have no affiliation with them. I don't care which one of these you use. That which gets measured gets results, period. If you're not journaling, you don't know where your mistakes are. It's really a game changer, especially for newer traders, because you can see the same things happening over and over again. You always want your equity curve to kind of go like this, right? You don't really want it to be like this. You just want your equity curve to go up, and every once in a while, you'll get an outlier. All right. But you really want to focus on getting that to 2 to 1. And this is the thing that kind of blows people's minds. I get the most comments on. Yeah, I'm right about 50% of the time. That's pretty much where guys are at. You'll see a lot of people online saying, oh, you know, I'm at 80%, I'm at 90%. You might be there for a month or a week. And yeah, I've had days like that and weeks like that. But when you start blending it over years and years, you're lucky if you're in like 55, 60%. You're in the upper echelon of traders, you know, the Jim Simons of the world, you know, the Steve Cohens of the world. So anyone that tells you anything different is just, they're just not being truthful, or they just don't know any better, quite frankly. So please consider that. But what I want to point out is 2 specific option trades and why they worked, and then why I think people are doing these wrong, and then how you could benefit from this. And it's just one mistake I saw over and over again with people trying to trade the GME and the AMC name. So let's get into it. Now, in front of you is the AMC calls. Now, if you've been following these videos, I actually showed this trade earlier. And the purpose of me showing this again is I walked through how we did the 5s and then the 8s, and these are just the 8s. And I just want to show you what and how you're supposed to trade these. And what you're looking for is not to hit once, but you're looking to be able to do this over and over and over again. You're not looking for a one-hit wonder. And that's what I see everyone trying to do here. They're just trying to hit once and just YOLO into something. So here we saw, and I just want to show you the time right here. You can see that it's literally at the end of the day when we did this. And so we were up on the 5s, and I said, roll them in if you want, or just leave them on, but use that and lever. Everything that I'm putting in here, I'm willing to lose. Everything that I'm putting in here, I'm willing to lose, right? And what I'm trying to do, and please understand this portion of it, I'm trying to stay in the option for the least amount of time possible. I'm not trying to stay in the option for the most amount of time possible. I want to be in it for the least amount of time possible, because you have theta decay, you have implied volatility decay. People are missing this. They're trying to say, we're going to hold this stuff and we're going to YOLO into it and we're going to hold it forever. Good for you. I'm here to make money, right? So I'm getting in right near the end of the day on this. Now, the other one I'm going to show you, I was not able to do that, and there was a couple reasons for that. If we take a look at how this is playing out, what happened at like 9:36, 9:38? I'm just blowing them out, right? I'm literally just blowing them out like right away, and I'm just getting right out of the way, right? I don't want to be in them. It's literally a home run. You paid 48 cents for something, and now you're blowing them out up here. You're at 900%, which is insane. And usually when I do these, and I want people to get this is 1% of my account. So if I lose that, it's 1% of this account. Everyone knows that there's multiple accounts I traded. If you watch these videos, you know that. But where am I going with this? That loss is going to do absolutely nothing if I came in and I'm zeroed out. You want to do something that you can do over and over and over again, not something you're going to do once and hope it works. That's nonsense. Right? It's absolute nonsense. And it really is. So please understand that. You want to spend the least amount of time in the option. You want to be roughly on these because there's no real stop to them. You want to have no more than 2% if you want to be super aggressive on the trade in it. And then you want to go from there. And what you're doing is getting out as fast as humanly possible as soon as it turns against you. You're not waiting. Okay, we're not waiting here. We're getting out, and you'll see that again. Now, this one's a little different, but in the same regards, it's similar, and this is the one I want to explain. We know that we're not supposed to put more than 1% into a trade, right? That's the first thing. We don't want to lose more than 1%. That's where my cutoff is on these kinds of trades. And then the account gets bigger and bigger, but what you're trying to do is you're trying to get into these for a multiple, right? That's what you're trying to do. You don't know if it's going to work or not. Let's just say it's a coin toss, just like that win rate is a coin toss, right? 50%, I think I'm at 53% year to date or something. So it's a coin toss. But what you're doing is money management principles. This is not rocket science. This is rudimentary stuff, guys. But what you're doing is you're sitting here and going, okay, I'll show you the timestamps and I can show you the live trade if you want to see it. But just comment below if you want to see it. But so when I'm in the room, I actually film myself trading, or the screenshot, I don't film myself. Anyway, but the 68 cents, okay, so we're in. So I saw it break, and my thought process was, I'm not going to get the opportunity to do the trade that I want to do at the end of the day. And there's all kinds of technicals that were telling you that this thing was going to get slaughtered, and you knew that a lot of let's call it hijinks was going on. So was I right on that? We could say I was right, but really, did the options really move between, where we closed over here and here? Not really. The options didn't move. I think I was up a couple hundred, here, or a couple thousand, whatever, in here, with the way that it moved. I wasn't up much. I don't even think I was really even up $1,000 on these things at any point. Maybe I was. I don't. But there was my neckline. I saw the break, and I'm like, man, we tested, we bounced. Now we're going to break. Can't you hold till 4? And the answer was no. So I had to act. So I acted, and I really wanted to get, my hope was that they'd be cheaper here and I'd be able to get even more off. Because again, it's that 1%, right? All right. So, and then I think I went a little over on 1%, but whatever. And then what I'm doing off the open is, and I made it real clear, and I'll show you those timestamps in a second. But what I did was I made it very clear to everybody off the open, I'm getting out. And all I did was just start blowing out all in here and get out of the trade. So what are you supposed to take from this today? You're supposed to take that when you're doing trades like this, you want to be in for the least amount of time possible. You can see how little I was in these. And then you want to make sure that if it goes to 0, you don't care. It's 1% to 2% of the account. You care, but you don't. But when you hit on these, they are game changers. So you're risking 1% to make 5 or 10% on the assets under management of that particular account. And as I have told everybody, and for newer members, this is a very aggressive account that I run. It's an account that I link to the room on the trades that I do in the community. But it's very aggressive the way that I trade it. And so you have to look at it and say, I'm willing to lose this amount of money. Now at the stock, all we're doing is this. So if we go back to that 30 level, which is right here where I saw it break, and that's really where I wanted to get involved. You can see these little necklines up here as well. But what I was trying to really do is I was trying to hang in there. And then when I started seeing it break, I'm like, you know what? I don't know if I'm going to get this opportunity. And then the games start after hours, and then everyone's like, oh no, we shouldn't have bought, puts, whatever. It's just going to constantly do that. But then off the open, again, all you're doing is you're just getting out. There's the timestamp so that you can see when we actually did the trade, the date and everything. And then what you're doing before you even start your day, everyone should be doing this. You're planning out. This was another day trade that we did. No, I bought calls on SMCI, and stock. But anyway, right at the close the day before. But let's just stick with this trade. So GME, I thought it'd be up like 500%. I don't know what the percentage was, but something awesome. It's just crazy. It just hit. And you get fortunate sometimes. But my goal was just let everybody know, hey, off the open, I'm out. I'm not playing with this thing. all day long and seeing what happens with it. And then here's John as I'm live trading, because I can't go out there and do this myself. Obviously, I can't type, talk, and text at the same time and trade. But you can just see that this is where we're getting out of those, and that's how we're doing it. Now, what's important about this whole setup and what you're supposed to get from this is the lessons. Okay? 1% to 2% of your trades when you're doing these kinds of option trades. And you want to be in for the least amount of time possible. Right? This is something that I have done for a very long period of time. I've been trading over 20 something years. I was a registered option principal for 9 years of that time. I can tell you that you don't want to be holding this stuff for very long periods of time. Even like the MSTR trades that I do when I trade options in this, I'm just going to tell you right now, I am not in for very long periods of time. And they are the best trades, and it does work. There's so much to cover today, but I really need to get into smart money, dumb money, and what's going on with the volatility. Now, in front of us is smart money, dumb money. And if this is your first time here, welcome. And we don't refer to it as smart money, dumb money. There's a reason for that. We refer to this as institutions, and we refer to this as retail. Now, why do we do that? Because this is calculated, smart money, by what institutions do, and dumb money is calculated by what retail does. Now, what is the difference? Smart money might buy more of the futures contracts or larger size, where some of the option plays that are odd lots or under 100 contracts would be more retail. So they take this and they divide it by smart money, dumb money. For our purposes, I wouldn't look at it that way, because when we go through the details, when dumb money or retail is buying, the market actually goes up. And so what we want to do is understand this so that we can use it to the best of our advantage. So by doing this, we just say institution and we just say retail. So for those that are newer, now let's just get into it and what we're seeing here. And we talked about this a couple weeks ago. We talked about this cross here. And at the time of that particular cross, you'll see that that's when we kind of started to break down. Now, the purpose of that is when retail is selling, they sell fast. And institutions just let retail do whatever they want. And institutions in no hurry to buy. What they do is they just get out of the way. And they just say, let's see how far they're going to sell down. Right? Do you ever see a stock drop in the middle of the day and it just gets pounded and then it gets bought up later in the day? That's just institutions letting retail just do themselves in. So we can just kind of see how that dropped from here, right? And that's the same time that retail stopped buying. And then about 2 weeks ago, we said, hey, you're seeing this turn and we're crossing to the upside. And we just pointed out, remember that when retail starts buying, what happens? Well, we start going higher. And as institutions sell, institutions move slower. So when they're selling slow into it, right? Whereas retail, they're just in a hurry. They got to get in right now. And so that will mark these pivotal moments in the chart. And what we're seeing is every single time, it's like clockwork, that these cross to the upside. Every single time you're marking a bottom. And we can just go through the chart and look at it. In front of us is just 3 years. But if you just kind of take these levels where they hit and they cross, for example, like here where they crossed and we just leave that line right there, you'll see it. And it's kind of funny, but it's really telling to the upside. And it doesn't mean that it has to be, that you're going to go straight up. I mean, you're still in a declining market here, right? So like here we were still declining. We can see that. What does this mean? It just means that when these things cross, you want to pay attention to them. So, and again, it doesn't always work. Oops, that kind of got a little goofy there. It doesn't always work. Nothing always works. But also, we know that we were coming off what? I'll say it, $1.7 trillion, right? And that's something else we're going to talk about today. We must explain the volatility in the market, because people keep waiting for this crash and they're looking at the volatility, but they're not understanding why there's volatility. This is really important for people to understand. Let's get to this. So here we are and we're trading up. Now, what do we have to pay attention to? This line. Why? Because every single time after you cross and you get above this line, that is when the big moves happen. But we just had the big move. Well, did we? There's a couple things that would point out that we didn't. We're going to cover a couple of those today, but there's some others here we'll have to go over during the week. But if we look at that level right there, did we really have the big move, or do we just get back to the high? That's not really a big move. That's just getting back to where we were. So what I'd like to do is just take a moment and go, okay, well, what happens when we get over these levels? Well, here's one. Let's get rid of that yellow. And here's another one. We'll make that one orange. That's a little easier to see, isn't it? Come back here and have a redo. There you go. And we'll just do another one right here. And so when we see this gives us a lot of a sense of what's going on, right? Now, there's also a spread associated with this where you take smart money divided by dumb money, and we're going to take a look at that as well. But what we want to do is just focus on this for a second. And what are we starting right here? Well, we could say that we're starting right now, right along with the cross. So we don't know up here, are we going to go up here or are we just going to stay here? Like, we don't know. But what we have to understand is that every single time this has happened for the past 3 years, And I really do. I know people laugh when I do it, but I just try to pretend that this doesn't exist, because people keep thinking that that's normal to go buy, an NFT and call it, which is a JPEG, and go spend $1 million. And people think, that's the future. I mean, it's just nonsense. But anyway, when you see this, what you want to do is you want to focus on how you can profit from it. You're over the overbought. They're selling down. Until institutions are done selling, that's what you want to see. You want the institutions to be done and that spread. And we will get to that spread. But again, I like looking at multiple time frames on this because I think it becomes a lot clearer for people to see it. So if we just look at this cross right here, and let's change that color up, and we'll go right here, and that color is hideous. So we're going to go back to this. And you can see that mark right there where we crossed, right? And that's important, because even when you're crossing on the smart money, dumb money, and the smart money is crossing on the downside, you can still see that you have that trajectory that follows down. One could even argue that, hey, when you cross on the downside, make sure you stop buying. And then you would go, well, does that work? Well, there could be something to it. And then don't touch it until you go back on the what? The upside, right? I mean, that might even be something that people might want to consider. Something to look at, like it might have just worked here as well. And it might have worked here as well, and might have kept you out of that entire sector, right? So if you did something like that, just to kind of put it in perspective, you would have missed all this nonsense. And again, you would have missed all that nonsense if you just use something as simplistic as that, right? So when you understand what these things are up here, what this does for you is it makes life a little easier. So again, that's not dumb and that's not smart. That's institutions and that's retail. All right. So again, when you understand the data, you're able to go through the data and make better decisions. The key point here is understand retail move fast, institution move slow. Okay, just think of it that way. And that's really very important for people to get. Just to look at different time frames, because I think it's helpful. Here's your cross right here. Here's your other cross right here. And let's just mark that off again, since it's like super easy to see now. I'll just draw that green line right there. And we'll just draw another one right there. And then you think about like all the ag that you just went through, right? Like all the aggravation you went, where you were trading in this, and over here you were super smart, and then all of a sudden you realize like you're not as smart as you thought you were, and then all of a sudden you're smart again. Yeah, that's because of this flip, right? Your intelligence did not change over the past 2 months, right? So when you understand this stuff, then we can use it to our advantage. And then one other time frame that I think is very helpful is just take a snapshot of 6 months, and you look and go, okay, well, where are we? Well, we're pushing. And again, when was the last time we flipped? Right here. And from that flip, we did fairly well. When did we flip again? Right here. We did fairly well. What happened here? We're just starting. We don't know if we're going to be up here for a day. We don't know if we're going to be up here for months. We don't know. All we can do is trade what's happening. And right now, this is what's happening. Let's take a look at this in spread form. Now, I'm a huge proponent of looking at things on a relative basis. And looking at things on a relative basis usually means looking at things on a spread. So I really like looking at the NASDAQ in relation to the S&P, XLF in relation to XLK, things like that. I want to know where the money's going, and I want to know who has the money, meaning who's driving the train, so to speak. This is all Sediment Trader. I have no affiliation with them whatsoever. I did reach out to them. I pay for this service. I did make sure it was okay that I show you this. So I think I should just give them a shout out, just because that's where I'm getting this from. But again, we're going to refer to the spread of this now. So this is just smart money divided by dumb money, and you get a spread. What we've been dealing with is when that spread increases, and the spread is increasing in value, then what we see is we start to see that kind of sell-off. And when it decreases, we would say that we start to see that bottom. Where we really see the bottom, where we tend to see that, is when we're just going sideways on that. That's really what we've been seeing. So for example, if we just look from here over in this time frame, which is about March, right? Maybe early April, but really March, and we just kind of mark off the same level from there over, you're going to see something I think is pretty fantastic. At least I think it is, that you're in that area where you just were ripping. And I think that's important to note. And what we were always watching, we watched this about a couple months ago and said, okay, we got to watch when we flip this level. So you're always looking for change. So you have a little change there, and then you can see how that affected here. Well, what happens when we break to the downside? And this is where it gets super interesting. And I'm going to overlay something else with this a little later in this video. But if we just mark these areas off and go, well, what happens here? Well, it seems to mark, even if it's short term, it tends to mark little areas of interest. Whereas when we break to the upside and we look at these, let me see if I can get a different color there. There you go. That's not too hideous, that yellow. What we'll see is we'll get this out of it, right? We'll get those tops. So when we break to the downside here, we're getting bottoms, right? When we break to the upside, we're getting tops. I mean, that makes sense, doesn't it? So again, we know that smart money moves slower, or institutions move slower than retail, right? Retail panics. They panic to get in, they panic to get out. They're a mess. So they're just very emotional. So that's what you're charting here, right? Emotion. So when you break here and we see what's happened the last times, what we do is just, you'd kind of look at that and go, okay, well, I see that, but what really happens? Well, the trigger to get out is really when it flips back over, right? But what you might want to do, might be helpful, is just to look at this and go, okay, well, if I was just going to do something as simplistic as measure time, well, this time was about 3 to 4 months that we got out of it. Okay. This time was a couple months. Back here, we don't really want to get into it for obvious reasons, but let's just call it a month. And then you go back here and go, oh, well, we were down here for about 4 or 5 months. Okay, well, that's pretty good. So now we're just beginning to get down here. So usually when it gets below here, if we use the past 1, 2, 3, 4 times, on average, you have to think that you're down here for about 2.5 to 3 months and it just started. And that usually leads to a move. Now, if we take a second and just take a moment to look at some different time frames here at the same thing, you can see that a little clearer. This is when you broke to the downside, and this is when you broke to the upside. And you can see that real clear right in here, right? And this is when we broke from here to the downside, and this is when we broke what? To the upside. So does this look like something that we'd want to watch? Yes, it's telling us something. Is it telling us everything? No, but it's telling us one thing. And so we're going to take this data point here and say, you know what, this flipped a week ago. Last time this flipped in mid-November and then flipped in, right at the beginning of April. Okay. And then it flipped in June, and then it ended in September. Okay. This is something that we want to watch. So if we look at that on a year and then we just take another time frame, and I like looking at things on different time frames. Why? Perspective. Because then you'll start seeing things, I think you see things a little clearer. And now you can see here, and now you can see what's going on right here. But I think this is really important to understand before we get into the volatility and why you're seeing so much volatility. Why maybe you don't have to be jumping and think every time it's going to just be a crash, right? There's a little bit of shift here in our mindset that we have to have. But first, it's really important that people understand why you're even seeing the volatility that you're seeing right now. Now, before we use an indicator, it's always important for us to understand what we're looking at. And what we're going to look at is we're going to look at margin interest. And it's important for you to understand why the volatility that you're seeing in the market and technology, this is not going away. This is actually normal. And a lot of people aren't getting that this type of volatility is normal. And there's a couple of things that they're misnomers here, but let's get into what we're about to look at. So the time frame is long term. The schedule is updated monthly, and the source is from the New York Stock Exchange. The construction of this is based upon a 12-month rate of change year over year among margin debt of U.S. investors. So it's a 12-month rate of change. So now you know exactly what you're looking at. Now, the first graph that we're going to look at is going to be I took from 1980. This goes all the way back to the 50s, but I took from 1980, and I did from 1980 for a reason. And again, what we're looking at here is in black is the S&P, and then New York Stock Exchange margin debt as a percentage of growth. Okay, that's what we're looking at right now. So why is this important? Because there's a couple of things that we're going to focus on. To start with, what we're going to focus on is this line. This is considered a line of under margined versus, quote, over margined. I really don't care for that. What I would use it as a demarcation line. That's what I would use it for. Are you deleveraging or leveraging? That's how I would use it. And you can see the 0 right here, and that 0, that's going to tell you that you are deleveraging for sure, right? You're getting off margin, which is negative, and you're getting on margin or positive over 20 right here. Why is this important? If you're deleveraging, the market's going to go down because you're selling stocks. Therefore, you have more supply. If the market is deleveraging, period, at any time, the market's going to go down. I don't care what's going on. The market's going to go down if you're deleveraging, period. And you will note that this margin level that we had here was one of the highest on average from here and here and here. And these events were marked on purpose. So this is inflation. This was the last time we had anywhere near the inflation that we had. This is the .com. This is the great financial crisis. And this was the pandemic and the inflated market thanks to the Fed. And that's where we're at. All right. And then if we mark these levels and those peaks, we can all see this pretty clearly. You can't really see this one. This went on actually for 5 years, different times, but I think it's pertinent to get this. So where is the area where this starts to kick in? Well, it continues as they put money to work, right? So I don't want to say that it's the 0 line that's where it goes. Where you want to look at these bottoms is when do they stop deleveraging? And how would you know that they stopped deleveraging? What would tell you that, right? I mean, that's really important. Well, if you're here and you're going down, you're deleveraging. Okay. If you're going down, you're deleveraging. And as you're deleveraging, what's going to happen? Well, very clearly, one thing's going to happen. The market's going to come down, right? So just understand this concept before we get into it, because I'm doing this so you understand the level of volatility you're going through and why the volatility in tech is going to pick up. It's not going to get worse. One of the graphs that people were looking at is the movements in equities on earnings, and they're shocked by it and how it's 2xing and 3xing what it's been over the past decade. And I'll explain that in a moment, what I mean by that. But what's important is why it's happening and why it's not going to stop, so that you can prep and you can make money off the movement that you saw this week, because this is the norm for technology. Right? This is why technology was always so hard to invest in, and why people would buy Procter & Gamble, and why people would buy Colgate and buy these other companies. We'll get to it. But I want you to understand this concept. If you're deleveraging, then the market's going to go down. If we're re-leveraging or putting more leverage on, we're going to go up. Well, what are we doing? We're putting more on. Where's the bottom? Right here. Putting more on. Where's the bottom? Right here. Putting more on. Where's the bottom? Right here. Okay. Get it? Got it? Good. All right. And then when you start to delever, what happens? The market goes down. It's not rocket science. It's really that simple. If there's less money to buy stocks, the market's going to go down. It's just that simple. Don't overthink the concept. What's important about the concept is from a volatility standpoint. We're going to get to it. We're getting there. We're going to tie this whole thing. We're going to bring it all home. But I want you to understand why. All right. So then we go back and we just look at 20 years, because I like looking at different time frames so you can get it. You see here, boop, boop, and then you can see these. Well, that's not doing it. Well, did you really delever? Not really. Okay. And then you're kind of just bonking around in here and you're not doing much and you don't really have extreme. We like extremes. Here you are, you're delevering, and what happened? You went down. Okay, what are you doing here? We're relevering, and what are we doing? I'm going up. Again, not rocket science. Now, why do you care about the amount of money that's on margin? You care because this is going to increase the volatility. The more money that you have on margin, and I'm going to point this out, I know I'm going to say 1.7 again, but the reason that the increase in margin rate did not affect you here is you had a backstop the entire time. That's why newer traders are having a really tough time right now with when you're seeing something like NVDA, especially like in the trading community. They're watching it and they're not used to it. They're like, oh my gosh, NVIDIA's at 950. Now it's at 918. It's going to crash. No, this is just volatility. This is just normal volatility that you should be getting used to, because it's going to continue. And I'm going to explain why now. Now, in front of you is Fed funds, and this is the Fed funds rate. This is what banks borrow money at. And then when they borrow this money, this is what they lend at based upon that rate. And you can see right now you're at 5.33%. So we're only going to go back to 1980, and you can see in this area in 1980, real clear that it was just absolutely insane what they were borrowing at, right? And so then we just start dropping. Okay. And so it just starts working its way down. And now what are we doing? You have your first higher high, by the way, that you've ever had. So I think that's worth noting. You haven't never had this in 40, 50. So if we look at this, what does this mean? All right. So if the banks are borrowing here, and this is where we're just going to do a little bit of banking now. The banks are borrowing, let's say, at a rate that's down here. And let's say that rate is, I will say 10%, right here at that 10%. They need to make money. So they're going to lend up here, and they're going to lend at this rate, and we're going to call this rate, I think it stands out more. They're going to lend at 15%. And then what they make in between that is they make this difference. Okay. So they're going to make 5% for every dollar that they lend out. Just think of it that way. All right. Now that could be margin interest, that could be commercial loans, that could be property, could be anything, right? But that's how they're going to make their money. They're going to borrow here and they're going to lend here. What's good about this for people is the lower the interest rate, the easier it is to borrow. The majority of people that have been trading are not used to what's going on right now. Now, what do I mean by this? Unless you've been trading for well over a decade, you're not used to margin interest at all. You're just not used to it. And this is what margin interest was like from when I started trading back in the day. But like all through in here, this was margin interest. Like it was nothing to be paying 7-8%, on your margin interest. Whatever you were carrying, that's what you were paying. And you don't have people that are doing that anymore, right? Like, oh my gosh, you're carrying a balance. Doesn't matter whether it's 10,000 or a million, whatever it is. But all of a sudden you're getting this payment that's hitting your account and it's like $1,800. And now you're like, well, what the heck's that? Oh, that's margin interest. So do you want to pay that if you're not making money? No. Do you want to pay it ever? No. How do you not pay it? you're not on margin. So what will happen is as margin is going up, as we just saw that margin is going up, right? We're seeing that right here. That margin rate is going to go up, right? Or the rate is going up, right? That is going up. As the rate of change of margin is going up and we're sitting right here, well, you're paying margin now. So what are you going to do about it? Well, there's only one thing you can do. You can realize what's going on, and then you can get on margin, and then you can get off margin, and then you're going to get on margin, and you're going to get off margin. And what is that going to do over and over and over again, right? And I'm changing the color on purpose because I want you to get it. Like each time you're going to be looking at doing something different. You're going to have less and less and less and then more. And each time it's going to be a different name and a different stock, right? So you might be in NVDA here, and then here you're going to be in a net because now we're going into software. So then the margin goes. So you have more money coming in the market from the margin that I just showed you. And despite having more money come into the market, right, from the margin we just went over, your interest on that is going higher. So as the money increases, the movements in the stock are going to increase. Therefore, the movements that you're going to have on a daily basis and for events are going to go up considerably. And this is really important because now if you tie all that together with the rates, understand that rates were zero here and here. So literally from 09 to about when the Fed started this insanity, right, when they started just giving away free money and everything, when you think about it, from 23 to 22, 23 to 09, people were like, what's margin interest? They never had to worry about it. Watch how this all gets connected. So that's why the market's moving the way it is. That's why when people will say things to me like this, the VIX is broken. The VIX is not broken. You're just not used to where the VIX is. The majority of people that have been trading or institutions understand that this is not a big deal. And what you're seeing is you're going to see this happen. You're going to see a couple massive changes. The number one change you're going to see is this. You're going to see the S&P continually grind higher because low beta names are going to benefit from the volatility. Well, that doesn't make sense. They're going to benefit because not everybody every day is going to now want to be in NVIDIA every day. Why? Why wouldn't they want to do that? Why wouldn't they be in NVIDIA? Well, I would say something like they're crazy, right? Well, not everybody wants to have their net worth go from, 762 to 925 in a month, whatever that would do to their account. Some people might want a percentage of that, but some people might just say, you know what, Procter & Gamble, JP Morgan, yeah, I'm good. And we'll explain why this whole sector is moving. There's a very specific sector that's moving that's in this field. We're going to get again to how it's all connected. So the first thing you have to understand is the volatility is here to stay. That is a good thing if you are a trader. I'm having a really good time with this. Right? This is my kind of market. It's a real market where you have to make real decisions. It also means you don't have to chase anything because you're going to get a chance back at it, usually, except certain conditions. But let's take us back to this, the VIX. This is when people think the VIX is broken. The VIX isn't broken, buddy. You just don't know what it looks like when you have margin interest. Okay? And the people that run institutions, do you think that they're going, the VIX is broken? They're going, no, we don't need puts. We got this. We just have to take all this money that was in tech, right, over here, let's say in the XLK names that was over here, and we're going to have to allocate that into some of the XLP names to reduce our Sharpe ratio, which is a completely different conversation for another time. So we don't have the volatility, but we still want to be in the right names. All right, so now you have that. Now there's two things that you have to understand about that. What this is going to do to you is this is going to convince you that every time that you're hitting highs, I'm going to take NVIDIA for example, that this time it's really going to crack. And you're going to say stock market crash, and some guy on YouTube is going to put a video out that says stock market crash because you're going to click on it. And it's not crashing. It's just normal average volatility. That is the first thing. This is normal now, okay? And people are like, oh my gosh, this is just absolute insanity. No, all that really happened here, if you take the past 2 days, what did you really do? You moved around 4% peak to trough. This is average volume. You're not used to it. What else this is going to do? The moves that you are going to have on earnings are going to become more and more outsized. Moves on earnings will be more and more outsized. We're all seeing it, and people are not understanding why. Because people don't have positions on the way that they did because of the margin interest. The other thing that they're doing is they're all piling into the names they want to be in with what? Margin interest. Remember, when you were going through what we were going through, margin interest was declining. Margin interest rate of change is going up. There's more money coming in, and that more money is not always deployed in the market. Why? because they're paying margin interest. That's why the VIX isn't moving. It's not broken. Okay, it's not. And also, that's why the volatility is here to stay. So please understand that. That provides huge opportunity for traders. Absolute huge opportunity for traders. So like today with NVDA, I just stay out of the way. And I just waited and I waited, and it gave me the opportunity that I wanted. We just kept marking it off over and over again. We're just waiting. I'm just waiting to see where, all right, where's the level? And the level for us, there was like a 916 or 918 down here that I wanted to get involved, and I just waited for it to flip. Also boils down to what we talk about, where you want to know your times of the day. Remember, 2:30, a dentist's favorite time of day, is when institutions start stepping in. Isn't that convenient how they decided to drop these all the way to that tooth hurdy level? Get it? Get that joke? That joke? All right. So here you are at 237. What do? We buy right in there. And we did something. I'm not going to get into the whole trade and what we did and what we saw, but that allowed us to do this. It allowed us to buy the 930s in case it really pushed. Sometimes these will gap fill and go right back to the break even. We all know it. But, we pulled out the 930s. They doubled. So you could either take in the whole trade or closed half and then had a free roll on them. And then we just closed the NVIDIA day trade and made money on it. $5, $6, $7 on some of it. And then $4 we cleaned some off, and they could have done whatever they wanted to with it, obviously, but I just wanted to show that. So your job here is to understand this and mark off your levels, because all you're going to get is volatility now. And the majority of people are going to look at this that don't have this kind of knowledge. They're going to look at it. I'm not saying I'm the only one with this kind of knowledge. I'm not. Any institution guy knows this, but just you're gonna fill gap fill. You're gonna come in and you're gonna drop hard, and people are gonna think that it's over or there's some news, because this is what you had in the past. You don't have a backstop. Margin interest is increasing. This is the new norm, and this is going to lead to massive volatility on any earnings move. So when you start seeing these names, like for example, next week, we all know that the big dog's coming out and NVIDIA is coming up with earnings. This will move 100 points like nothing. It's the reason why SMCI moved the way that it did on earnings. And then all of a sudden it bounced back. Well, why would it bounce back? Because after everybody read it, they looked at it and said, oh, it really wasn't that bad. But during this, they're going, oh my God, I'm on margin and this is happening. And you can see these moves everywhere. If you go and look at these moves, like even on PANW, look how it dropped and then it lifted up. If you go and look at these moves over the past year on earnings, you'll see it. Like on these names, they're getting wider. Not all of them, but they're getting wider and wider. And the moves are getting more violent. This is what we always had to deal with before. This is why you wanted to do fundamental research, so that you knew what name you wanted to be in before earnings. Look at Dell. Look at these names. And it's not just these names that are doing it. Look at the downside when you look at Lulu, when people don't want $200 stretchy pants anymore, right? It's the same thing. This is not going to go away, but there's other people that are benefiting from it. Now, if you're in the community, you already know this because we've been talking about it for months, but capital markets, all the investment banks are benefiting from these. Are you watching certain names pull away? Like you're looking at Citigroup and going, well, why isn't that moving the same way as JP Morgan? Well, who's one of the largest investment banks in the world, right? Where all the institutions are, JP Morgan, who else? Goldman, right? So that when you start seeing these names, right? See, when you understand what actually is happening, this doesn't look crazy anymore. Right? You start to go, oh, well, that actually makes sense because they're making money. What? Well, the earnings are up. Well, why are they making money? Oh, margin interest, right? Because the margin interest is going up and they get the margin interest. All of a sudden, it's a completely different revenue source that no one has really modeled in. And this is why you're seeing these little guys, even like VCTR and all these guys, they're just like ripping after earnings because people are going, well, what's going on here? Margin interest, right? Say it with me. Margin interest, but like even Interactive Brokers hitting all-time highs. All these names. Once you connect the dots, you can put this all together and you can understand what's happening and you can benefit greatly from this. Please comment if you found this helpful. Now, the majority of you know what a heat map is, but what this does is this shows you exactly what was moving based upon market cap. I just want to give everybody that watch these videos like one really quick tip that you could take with you. There's a lot of tips in these videos, as you're aware. But I want to give one real simple way to look at the world, and it will make your life a lot easier. So in front of you is a heat map, but what a lot of people don't know about these heat maps, this is TradingView. It doesn't matter to me which one you use. You can sort them. You want to find one that you can sort. And so what I want you to get from this is there's value in this, so watch. So if you go here and you see the market cap, performance, sectors, etc., right? And they'll break it down. These buttons over here are where the money is, and I'll explain. So if I'm looking at this chart, and I want to go, okay, well, I want to know everything that was up 3% on the day. All I have to do is go over here and click off those buttons. And then I can see what were the big winners of the day. And do I see any kind of pattern? And the answer is, well, I don't really see, I see a pattern. I see a pattern. But like, for example, you would go here and go, well, here's DuPont, here's TSCO. Okay, well, they're both what? Industrial names. All right, maybe I should be looking at the industrials. Well, we know that because of the weak dollar, right? Okay, then I'd go over here and go MPC VLO. Well, if I wanted to buy energy, what energy name should I be buying? Right? All this you can learn in like, boom, 2 seconds. Okay, Starbucks. Well, that didn't make me happy because I'm short Starbucks. But FCX, you can see what's going on here, right? And okay, well, maybe I need to look back at copper. What's going on with FCX? What's going on with SCO? What's going on with tech, right? And you go from there. Okay, same thing could be said over here with the insurance names. The flip side of that is you go here and go, okay, what is breaking down? Okay, well, Lam Research, that's kind of weird out of all of them, but maybe there's something there. But this tells you that you have some issues, and you should be able to see those issues pretty clearly. Well, I don't know what's going on with Dollar Tree and Dollar General, but that whole sector is getting destroyed. So if I'm long or if I'm looking for a short, maybe it's in there. And then you go here and go, well, what's going on with Seagate? What's going on with Western Digital? Why are they getting destroyed today? Right? What are people seeing? Because they're the same business. So what are people seeing there? Is that something that I need to be either concerned about, that I'm long, or something that I need to maybe short? That's it.